The one subject that has international businesses worried when they trade on the Chinese mainland is tax. That's because tax is difficult to understand. Terence, HKTDC's China business advisor, has been giving general advice on the subject of tax. First of all, Terence, are the number of taxes actually growing for foreign companies on the mainland?
After China joining the WTO in 2001, China should adopt the electoral treatment, the principle of electoral treatment of WTO, and China really do it. So today, the number of tax imposed on foreign companies, including Hong Kong companies, is the same as the local companies. For the foreign companies, if they want to export to China, well, we need to take good care about the import tariff and import VAT.
So in the past, foreign companies had all kinds of tax holidays. Those have all now disappeared.
Today, the Chinese, they didn't provide tax holiday or preferential treatment to foreign companies. They provide tax holidays or preferential treatment to those industries they want to develop, like high-tech. If you are involved in high-tech industry, no matter you are foreign companies or local companies, you have the same tax holiday. You're entitled to have the same preferential treatment.
So just what are the taxes you have to pay as a foreign company there on the Chinese mainland?
Well, first of all, it must be profit tax. In China, is corporate profit tax. It is 25% for general industry or trading company or retailing companies. Selling inside China, there's a value-added tax, which is normally 17%. If you are involved producing, processing luxurious goods like automobiles, cosmetics, jewelry, there's also we call consumption tax. The consumption tax rate is from 5% to 45%. This is the major tax for a company running in China.
So consumption tax seems to be on an almost sliding scale, which means it's rather difficult to understand your turnover if you're a foreign company there on the Chinese mainland.
That is why we need to take good care on that. You need to find out, for example, if your goods was made in outside China, you want to export to China. For goods entering into China, there's two major tax. One is tariff. Tariffs can be 0%, it can be 40%, even more. It depends on what type of product you are. Other than the import tariffs, there's an import VAT. It is, generally speaking, it is 17%. For those luxurious goods like automobiles, yachts, cosmetics, wine, the Chinese government also impose import consumption tax. So sometimes it adds up more than 50%. So for the foreign companies, if they want to sell to China, we need to understand this in order to calculate the cost, how much markup for you to sell in China.
So what strategies would you advise foreign companies to take in ameliorating or reducing their liability to tax?
Well, generally speaking, for goods export to China, you can't escape paying those taxes. But there are some ways it can help you to reduce the tariff, the import tariff. Of course, if you make in China, there's low import tariffs. What you do is just pay the VAT. If you are involved in luxurious goods, you need to pay the consumption tax. On the other hand, because Hong Kong and the Chinese government has signed we call closer economic partnership arrangement. If the goods made in Hong Kong, that goods when export to China is exempted from paying the import tariff. So made in Hong Kong or made in China can help you to reduce the import tariff.
So would you say it would be a better idea to set up a company in Hong Kong for tax rather than on the Chinese mainland?
For companies entering into China, Hong Kong is a very good location for them to gather information, to understand China market, to do business with Chinese companies here. Because in Hong Kong, we have a sound legal system. So it helps.
Of course, in Hong Kong, you're paying far lower tax.
Of course, Hong Kong's profit tax is lower here. But the most important thing is because China is still an emerging market, the risk doing business there is a little bit higher than in Hong Kong.